This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the Luxembourg Fundcast. Today, we're diving deep into the fascinating and, frankly, fast-evolving world of private equity structuring and servicing right here in Luxembourg. For you, our discerning finance and legal professionals, our mission today is really to cut through the noise. We want to give you a masterclass in what truly matters right now. We'll cover the essential frameworks, the latest regulatory shifts, the nitty-gritty of drafting those key documents, and take a pragmatic look at the cost and strategic upsides of operating for the Grand Duchy. Luxembourg is the hub for private capital, no question, and understanding its nuances is absolutely key to staying ahead.
Absolutely. The private equity landscape here in Luxembourg, it's really a testament to blending stability with, well, incredibly dynamic evolution. Our famous toolbox of investment vehicles, it still offers unparalleled flexibility for fund sponsors, fitting almost any strategy you can think of. But what truly defines 2025, I'd say, is a noticeable trend. A palpable convergence in supervisory oversight, and a significant uptick in regulatory focus on operational diligence. Regulators like the CSSF, the Commission de Surveillance du Secteur Financier, and the AED, the Administration de l'Enregistrement des Domaines et de la TVA, they're actively extending their reach. They're demanding more robust governance and compliance across the board. And this is effectively blurring the lines between what we traditionally called, regulated and unregulated structures. For managers and their advisors, navigating this isn't just about picking the right vehicle anymore. It's really a strategic commitment to a higher standard of operational excellence, period.
That's a powerful statement. A higher standard of operational excellence. So what does this convergence, this blurring of lines, mean for your strategy and operations in the months ahead? I see two absolutely critical developments that seem to demand immediate attention.
You're right to pinpoint them. First, and this is a big one, is the impending transposition of AIFMD2. That's the Alternative Investment Fund Managers Directive 2. The deadline, April 16th, 2026, might seem a ways off, but it's a profound catalyst. This isn't just a tick box exercise. It demands an immediate, thorough review of your existing EU-based substance, your delegation frameworks, and for many, your loan origination policies. If you're running a loan originating fund, this is definitely your alarm clock.
Okay, AIFMD2 definitely one to watch closely. What's the second development?
Second, and just as impactful for today, is the intensified supervisory convergence we've really seen throughout 2025. Both the CSSF and the AED have tightened their operational and compliance nets. We've seen stringent new rules for depositaries and how you handle net asset value or NAV errors. Perhaps even more importantly, anti-money laundering AML and countering the financing of terrorism CFT reporting obligations have significantly expanded. They now include previously unregulated fund structures. The message is clear. The expectation of operational rigor is rising across the board no matter what your fund type is.
Right. So with these pivotal points setting the stage, let's dive into the core of how private equity thrives here. To really master Luxembourg, you need to understand its foundational instruments and these evolving regulatory currents. It's a legal framework that's sophisticated, flexible, and, as you say, constantly adapting.
Exactly. The choice of vehicle is the foundational strategic decision. Luxembourg offers a quartet of principal options, each with distinct legal, regulatory, and tax characteristics. Think of it as a specialized toolbox, right? Each tool designed for a particular job. Let's unpack the most prominent ones.
Okay, let's start with the workhorse.
The workhorse indeed. First, we have the Special Limited Partnership, or SCSP Société en Commandite Spéciale. We often call it the unregulated workhorse. Introduced by a 2013 law, it mirrors the, highly successful Anglo-Saxon limited partnership model. Its key feature: no distinct legal personality. This means the partnership isn't a separate legal entity from its partners. What's truly powerful here is the immense contractual freedom, dictated almost entirely by the Limited Partnership Agreement, or LPA. This allows managers and investors to tailor everything capital calls, distributions with minimal legal constraints. You need at least one general partner, the GP, with unlimited liability, and one or more limited partners, LPs, whose liability is capped. For a purely unregulated SCSP, say an alternative investment fund, or AIF, managed by a sub-threshold AIFM, it offers maximum flexibility. No statutory minimum capital, no investor restrictions, no direct CSSF prudential supervision. And tax-wise, it's transparent. That avoids an extra layer of tax at the fund level. It's truly a blank canvas for sophisticated strategies.
Maximum flexibility. Okay, what's next in the toolbox?
Then there's the Reserved Alternative Investment Fund, or RAIF, Fonds d'Investissement Alternatif Réservé, our supervised by proxy favorite. Introduced in 2016, the RAF is, well, ingenious. It combines the legal and tax features of regulated funds but skips direct CSSF prior authorization and supervision.
How does it manage that?
Good question. By mandating the appointment of an external, fully authorized AIFM alternative investment fund manager, which is supervised by its competent authority, like the CSSF or a Luxembourg AIFM, so it's effectively supervised by proxy. This design means a significantly faster time to market, often weeks instead of months. Our RAF needs a minimum net asset value of 1.25 million euros, and that needs to be reached within 24 months, a period extended by the 2023 modernization law, by the way. It's aimed at well-informed investors, meaning those sophisticated enough to understand and bear higher risks. Tax-wise, it's flexible, usually tax-exempt like a CIF, with just that nominal annual subscription tax of 0.01%, or it can opt for the SICAR tax regime if it focuses on risk capital, potentially giving it access to double taxation treaties.
Interesting. So flexibility and speed. But with that indirect supervision, what about the more traditional regulated options?
Right, the fully regulated route. Next up is the Specialized Investment Fund, or CSSF Fonds d'Investissement Spécialisé. This is our regulated gold standard. Governed by a 2007 law, the CSSF is the archetypal regulated AIF. It requires prior CSSF authorization and is under permanent supervision. That regulated label that provides significant comfort for more conservative institutional investors. Like the RAF, it's for well-informed investors and needs to hit that 1.25 million euro NAV mark within 24 months. A key differentiator, though, is its mandatory risk spreading requirement. CSSF practice generally means a CSSF won't invest more than 30% of its assets or commitments in any single issuer. This influences portfolio construction quite significantly. Tax-wise, CSSFs are highly efficient. They're exempt from corporate income tax, municipal business tax, net wealth tax. The primary tax burden is that annual 0.01% subscription tax.
Okay, the CSSF for the regulated comfort. And the last one, the specialist.
And finally, the investment company in risk capital, or CSSF Société d'Investissement en Capital à Risque, the venture capital specialist. Established way back by a 2004 law, the CSSF is also fully CSSF regulated, but it's purpose-built for private equity and venture capital strategies, facilitating investment in risk capital, which is quite broadly defined, its defining feature. The complete absence of a mandatory risk diversification rule. This means a CSSF can legally put its entire portfolio into a single company. Perfect for focused, high-conviction strategies. It needs subscribed capital of at least 1 million euros within 24 months, that period also extended by the 2023 modernization law, and it's reserved for well-informed investors who really understand the high risks involved. Its tax regime is unique. It's a fully taxable corporate entity, which helps it benefit from Luxembourg's double tax treaties. And this is crucial income derived from securities representing risk capital, things like dividends, capital gains, liquidation proceeds, is entirely exempt from Luxembourg tax.
That's quite a diverse toolkit. But what's fascinating here is how the Luxembourg fund ecosystem constantly adapts. It's not static.
Yeah.
You mentioned the 2023 modernization law, but from 2023 to 2025, we've seen a flurry of other updates too. What are the key shifts that fund managers absolutely must keep on their radar right now as of August 2025?
Indeed. The pace of change has been notable. The 2023 modernization law, which took effect July 28, 2023, was significant, as we discussed. It practicalized things like extending that minimum capital runway to 24 months for CSSFs, CSSCRs, and RIFs. It also explicitly confirmed that RIFs can be marketed to retail investors in Luxembourg, provided those investors meet the well-informed criteria. And it introduced new subscription tax exemptions for LTIFs, European long-term investment funds.
And more recently, what's happening in 2025 specifically?
Looking specifically at 2025, CSSF Circular 24856 came into force on January 1st. This is a real game changer for NAV error management. It repeals the old framework and now applies to all AIFs, including RAIFs and SCSPs, bringing them under a harmonized set of rules. It mandates clear policies for reliable valuation, sets materiality thresholds for errors, and outlines procedures for investor indemnification if there's an incorrect NAV.
Okay, NAV errors getting stricter scrutiny. What else?
And then in May 2025, the CSSF updated its AIFM law FAQ, that's version 24, with critical clarifications for depository duties. Depositories now have stronger verification obligations for assets held by third-party custodians. They must obtain and reconcile end-of-day position data directly from the custodian. Crucially, for private equity and other illiquid strategies, it introduced a new requirement for mandatory ex-ante controls on the acquisition of illiquid assets.
Ex-ante, so before the transaction.
Exactly. This means the depositary now plays a pre-transaction gatekeeping role, not just post-trade oversight. It's a significant shift in their function for these asset types.
So this isn't just about tweaking rules. It sounds like a fundamental shift, this convergence you mentioned earlier. What does it really mean for fund managers on the ground? What's the core insight here?
The core insight, I believe, is that Luxembourg is strategically forcing a regulated mindset on all private capital, irrespective of a fund's formal regulatory status. These actions impose regulated style obligations, operationally, even on unregulated or indirectly supervised vehicles like the SESP or RAIF. The compliance burden isn't disappearing. It's shifting to key functionaries like the AIFM, the Depositary, and the Funds Board, or GP. Managers must recognize that choosing an unregulated vehicle, no longer means quite escaping robust compliance. It simply refocuses the supervisory lens onto your operational rigor and the rigor of your service providers. It's about future-proofing your fund, really, making it ready for perhaps a wider investor base and a more integrated European market down the line.
Future-proofing. That makes sense. And speaking of the future, AIFMD2 looms large.
And speaking of future-proofing, AIFMD2 is absolutely the next big wave. The final directive was published in the official journal back on March 26, 2024. Member states must transpose it into national law by April 16, 2026. That deadline is firming up. Key changes are significant. There's a new harmonized European framework for loan originating funds, requiring things like a 5% skin-in-the-game risk retention provision and imposing leverage limits, 175% for open-ended funds, 300% for closed-ended. This will definitely reshape direct lending strategies. It also reinforces substance requirements for AIFMs, mandating at least 2 natural persons employed full-time or equivalent who are executive members resident in the EU. Substance is key, and there's enhanced transparency around delegation arrangements. AIFMs will need to provide much more detailed information on delegation to their national regulators.
Substance and delegation under the spotlight. What else is pressing right now in 2025?
Another critical development for 2025 is the expanded AED AML-CFT oversight. This impacts reporting year 2024, with deadlines that fell in May and June of this year, 2025. The AED has formally extended its AML-CFT reporting obligations to all unregulated AIFs under its supervision. That explicitly includes SCSPS.
So even the most flexible partnerships are now formally in the AED's AML net.
Correct. These funds now must appoint an RR responsable du respect des obligations and an RC responsable du contrôle du respect des obligations. Think of them as dedicated AML compliance officers, internal or external. They need to submit an annual RC report and a comprehensive AML-CFT questionnaire to the AED. This truly formalizes AML-CFT supervision across the entire unregulated fund sector in Luxembourg. There's no escaping it.
Okay, so AIFMD2 coming, increased AML oversight already here. It sounds like all these regulatory changes might be orchestrated towards a grander strategic pivot. Is Luxembourg making a deliberate move towards what some call the retailization of private assets?
Absolutely. I think when you connect the dots, these actions clearly demonstrate Luxembourg's deliberate strategic positioning for exactly that, the retailization of private assets. Enhancements under LTIF 2.0, the European Long-Term Investment Fund Framework, which became Luxembourg law on February 6, 2025, were explicitly designed to make long-term private assets more accessible to retail investors by relaxing investment rules. The 2023 modernization law supports this directly, remember, by granting that subscription tax exemption for LTIFs and clarifying that RIIs can be marketed to well-informed retail investors. This opens up entirely new capital-raising avenues for managers, no doubt, and it's but it also introduces new complexities and responsibilities concerning investor protection and disclosure standards when targeting that retail or semi-retail market. It's a calculated risk, certainly, and potentially a massive opportunity.
A massive opportunity, but with new responsibilities. Understood. So we've explored the strategic choices, the vehicles, the dynamic regulatory environment. Now let's get practical. How do you actually go from a commercial idea on paper to a live fund? This is where agreements become binding legal text, and that delicate balance between manager and investor interests is struck.
Right. The nuts and bolts. The heart of any fund lies in its documentation. While it can seem complex, 2 principal documents really define a fund's existence and operation. There's the Limited Partnership Agreement, LPA, for partnership structures like the SCSP, and the Private Placement Memorandum, PPM, for other fund types like SFs and RAFs. The LPA is supreme for partnerships, largely due to that contractual freedom we discussed. It literally is the commercial deal codified between the GP and the LPs. The PPM, on the other hand, is a mandatory offering document for the other fund types. It must contain all the information necessary for an investor to make an informed investment judgment. And crucially, these aren't just boilerplate documents pulled off a shelf. They're the result of often intense negotiation and truly embody the fund's commercial and operational soul.
Let's dissect some of that soul then. What are some key clauses people wrestle with? The economics must be central.
Absolutely central. Let's talk about the waterfall. This is the contractual mechanism dictating the priority and manner of distributing investment proceeds. It's the core of the economic alignment. It's typically a classic four-tiered sequence. First, return of capital. 100% of distributions go to the LPs until their total contributed capital plus allocated expenses and costs are fully returned. Second, the preferred return. Again, 100% to the LPs until they achieve a cumulative preferred return, the hurdle rate typically around 8% annualized. Third, the GP catch-up. Now the GP steps in. 100% of distributions go to the GP until they have received their agreed percentage, usually 20%, of the total profits distributed so far, covering both the preferred return and the catch-up amount. And finally, the final split, often 80-20. Once the catch-up is complete, remaining proceeds are split, typically 80% to the LPs and 20% to the GP. That 20% is the famous carried interest. It's a carefully choreographed dance of profits.
A very important dance. What about governance? How is control balanced?
Governance and control are just as critical. The LPA meticulously balances the GP's authority with LP rights. You have key person provisions. These identify critical senior executives at the manager. If one of them ceases to devote a specified amount of professional time to the fund, it can trigger a key person event. This usually automatically suspends the fund's ability to make new investments the investment period until the LPs vote to reinstate it. Heavily negotiated, as you can imagine. Then there are clauses for GP removal and no-fault divorce. These are mechanisms allowing LPs to remove the GP, either for cause, think fraud, gross negligence, material breach, or even no fault, typically requiring a supermajority vote, maybe 75% or more of total LP commitments. A powerful check on GP authority. And don't forget the advisory committee, or LPAC. It's usually composed of representatives from the largest or most strategic LPs. It has consent rights over critical conflict of interest matters, things like transactions with GP affiliates, changes to valuation policies, or dealing with potential LPA breaches.
So checks and balances. What about fees and other investor protections baked into these documents?
Fees and investor protections are always paramount in negotiations. The management fees and expense allocation clauses define the management fee, typically 1.5 to 2% of committed or invested capital annually. But just as important is the detailed negotiated allocation of fund expenses versus manager expenses. LPs meticulously scrutinize costs they perceive as being the manager's overhead rather than legitimate fund operating costs. And then there's the most favored nation, MFN clause. This is almost non-negotiable for institutional investors today. It guarantees that if another investor negotiates more favorable terms in a side letter, the MFN beneficiary has the right to elect those same better terms. It ensures a level playing field, at least in theory. The exact scope of the MFN, what it applies to, any carve-outs is always a subject of debate, though.
Negotiating that LPA or even the PPM sounds like a very delicate dance indeed. Balancing market norms, legal nuances, often opposing interests. It really is an art form, isn't it?
It absolutely is. The negotiation is fundamentally about aligning interests, or at least managing the inherent tensions. The GP seeks operational flexibility, minimal administrative burdens, and clear protection of their carried interest stream. LPs, on the other hand, seek aligned incentives, transparency, robust governance structures, and strong investor protections. And what we've seen over the years is the increasing dominance of large institutional investors and their specialist legal advisors. This has really shaped a market standard for many key terms. Significant deviations from these norms can face protracted fundraising cycles.
You mentioned side letters earlier in the context of MFN. Can you expand on their role?
Yes, the side letter. It's a separate, legally binding contract between the fund, the GP, and a specific investor. Its purpose is to modify or supplement the main LPA or fund documents for that particular investor. They're used to accommodate unique commercial arrangements, like a fee discount for a large early investor, or specific legal or regulatory requirements the investor might have Thanks enhanced information rights, specific tax undertakings, maybe co-investment rights. AIFMD actually requires the disclosure of any preferential treatment granted via side letters to other investors, which essentially formalizes and strengthens that MFN process we talked about.
So what are some of those market standards or red lines LPs often draw as of, say, mid-2025?
Good question. Market standards evolve, but as of now, some are pretty firm. For instance, GPs asking for indemnity against acts of simple negligence is strongly resisted. The market standard generally carves out gross negligence, fraud, and willful misconduct from the GP's indemnity protection. Another common expectation from LPs is that 100% of certain fees the GP or its affiliates might receive from portfolio companies, things like transaction fees or monitoring fees, should be used to offset the management fee paid by the LPs. It's about avoiding fee leakage. Understanding these unspoken rules is crucial for a smooth negotiation.
Absolutely crucial. Okay, let's shift gears to the practicalities of cost and time. Launching a private equity fund is a significant undertaking, both financially and temporally. It's vital for managers and their backers to have a clear understanding of the costs involved and a realistic timeline. So what are we looking at for the price of entry?
Costs generally fall into two main buckets: the one-off formation expenses and the ongoing operational expenses. For formation costs, the biggest chunk is typically legal and structuring fees. This covers drafting the LPAPM, tax advice, setting up entities, handling regulatory applications if needed. It adds up. For regulated funds like the CIF or SICAR, you also have regulatory fees payable to the CSSF. There's a one-off examination fee, currently €4,650 for a standalone fund, $9,250 for an umbrella structure based on a regulation from late 2022. And then you have notary and registration fees for things like the notarial deed required for incorporation of corporate forms or RAIs, plus filing fees with the Luxembourg Business Registers, the LBR. These are generally fixed fees per document.
So those are the setup costs. What about running the fund year after year?
As for operational costs, these are annual and recurring. You've got AIFM fees if you use an external AIFM covering portfolio management, risk management, regulatory compliance. There are administration fees for fund accounting, NAV calculation, maintaining the investor register. Depository fees for safekeeping, cash flow monitoring, and oversight duties usually charged as basis points on assets. And of course, annual audit and tax fees for the statutory audit and tax return preparation. Regulated funds also pay annual supervisory fees to the CSSF, currently €4,650 per annum for a CIF or SICAR. Now, while unregulated funds don't pay a direct CSSF supervisory fee, they do incur significant compliance costs, especially now with that expanded AML-CFT reporting to the AED we discussed. Other ongoing costs include things like domiciliation agent fees, independent director fees if applicable, and potentially value-added tax or VAT. It's worth noting that VA on most fund services is generally non-recoverable, but a crucial exemption exists for services deemed essential to the management of an AIF. Getting that VAT treatment right is important.
Right, that VAT point is key. Given that legal fees are often the largest single component of setup costs, how do law firms typically price their services? And what should managers be particularly aware of?
Law firms typically offer a few common fee structures. You might see fixed fees, which offer cost certainty for standard setups, or capped fees, where work is billed hourly up to an agreed maximum, or simply standard hourly rates, especially for more complex or heavily negotiated structures. But a crucial investor-driven provision in modern LPAs that managers absolutely need to be aware of is the organizational expense cap.
The OEC, right?
Exactly, the OEC. This clause effectively limits the total amount of formation and setup costs, legal, regulatory, establishment fees that can be charged to the fund. Any excess costs above this negotiated cap must be borne by the GP or the manager personally. This really imposes cost discipline on the setup phase. It's also market practice generally for this cap to be stated exclusive of any non-recoverable VAT, so you need to factor that in too.
Okay, cost discipline via the OEC. Now what about time? Speed to market is a huge competitive factor. How does the choice of vehicle impact the setup timeline?
It impacts it profoundly. For unregulated or indirectly supervised funds like the RAIF and the SCSP, speed is the key advantage. Legal establishment, the actual creation of the entity, can literally take weeks. A RAIF, for instance, can be incorporated via notarial deed typically within 5 business days, and then LBR registration might take another 20 working days or so.
Weeks sounds incredibly fast. Is that the whole story?
Well, that's the legal entity creation. The true time to market is often dictated by achieving operational readiness. This means completing the negotiation and extensive due diligence process with your chosen AIFM depository and central administrator. That can easily add several weeks. Opening bank accounts can also be a critical path item, so that theoretical 2-week legal launch might realistically stretch into a 2-month or even longer reality to become fully operational, especially for a first-time manager navigating these relationships. These are sort of the hidden operational timelines.
Right, the operational setup is key. And for the regulated funds.
Regulated funds like the CIF and SICAR, by their very nature, have inherently longer and more structured setup timelines. You're looking at a formal CSSF application process. Generally, you should allow somewhere between 3 and 6 months from the initial submission of a high-quality file to receiving final CSSF approval. The official legal deadline for the CSSF to make a decision is technically 6 months from the receipt of a complete application file. But importantly, the clock stops whenever the CSSF raises queries and is waiting for responses. So the overall timeline depends very heavily on the quality and completeness of your initial submission and how responsive you and your advisors are to any CSSF questions.
3 to 6 months versus potentially a couple months operationally for the others. A significant difference. So after covering all these technicalities, the vehicles, regulations, documents, costs, timelines, let's zoom out for the final perspective. What are the fundamental reasons behind Luxembourg's undisputed leadership in private equity? What are its ultimate unique selling points that keep attracting managers and capital?
Luxembourg's preeminence isn't accidental, and it's not down to just one thing. It's really a powerful synergy of several key attributes working together. First, as we've discussed, an unparalleled and adaptable legal toolbox. This comprehensive suite of investment vehicles, from the incredibly flexible SCSP to the fully regulated CSSF, truly means there's a structure tailored for almost every strategy and investor base imaginable.
The toolbox is definitely key. What else?
Second, stability and responsiveness. Luxembourg offers unwavering long-term political, economic, and social stability. That's foundational. But crucially, this stability is combined with an agile and responsive legislative and regulatory process. There's constant dialogue between the government, the regulator, and industry bodies like ALFI, the Association of the Luxembourg Fund Industry, and LPEA, the Luxembourg Private Equity Association. This ensures continuous updates to the framework, like the creation of the RAIF in 2016 or the 2023 modernization law. The ecosystem never stands still. It evolves with the market.
Stability plus agility, a powerful combination.
Third, tax efficiency and neutrality. The Luxembourg tax regime for funds is specifically designed to avoid creating an additional layer of taxation for international investors pooling capital through the jurisdiction. We see this with the tax-transparent SCSPS, the generally tax-exempt Fs, and that specialized SICAR regime. The goal is clearly to facilitate cross-border capital flows, not to impede them with punitive domestic taxes at the fund level.
Tax neutrality is always attractive. And distribution.
Fourth, it's a global distribution hub and provides the European passport. As a founding EU member, Luxembourg provides AIFMs based here with that invaluable marketing passport. This allows them to market their funds to professional investors across the entire European Economic Area with a single authorization. This unparalleled market access, combined with the global recognition and acceptance of Luxembourg fund structures, really solidifies its position as a premier cross-border distribution hub.
And finally, the people aspect.
And finally, absolutely critical, is the deep and multilingual ecosystem of expertise. Decades of leadership in the fund industry have cultivated a critical mass of world-class multilingual service providers. We're talking AIFMs, administrators, depository banks, top-tier international law firms, the Big Four audit firms, specialist consultants, all with deep experience in private equity and alternative funds. This creates an environment of efficiency, expertise, and operational excellence that is genuinely hard to replicate elsewhere.
That's a very compelling list.
Yeah.
So what's the overarching effect of all these unique selling points together? How do they really solidify Luxembourg's position year after year?
It creates a powerful, self-reinforcing network effect. The initial attraction stability, the toolbox, tax neutrality drew in the first wave of funds. This, in turn, cultivated the local expertise we just talked about. More expertise and efficient service providers led to smoother, faster fund launches, which attracted more managers and more capital. As the number of Luxembourg funds grew, international investors and their advisors became deeply familiar and comfortable with the jurisdiction's structures, establishing them as a kind of global standard, especially for cross-border investment. This economic importance then gives policymakers a strong incentive to remain innovative and responsive, constantly refining the toolbox to meet market needs, which further reinforces the hub's attractiveness. So each new fund choosing Luxembourg adds to the credibility of the hub, deepens the talent pool, and reinforces investor confidence, creating this virtuous cycle. It's not just a jurisdiction anymore, it's truly a central global ecosystem for private equity.
A virtuous cycle. That's a great way to put it. As we wrap up this deep dive then, let's quickly revisit the two most pressing takeaways for you, our listeners, here in August 2025.
Okay, the two key takeaways for right now. First, the strategic imperative to prepare actively for AI FMD2. With that April 16th, 2026 transposition deadline firmly on the horizon, proactive assessment and bolstering of your EU-based substance, and a thorough review of all your delegation arrangements are absolutely crucial. This isn't optional planning, it's foundational work that needs to be underway.
Right. Prepare for AIFMD2 now. And the second?
Second, embrace the new operational reality of heightened supervisory scrutiny and convergence. This means accepting expanded formal AML reporting requirements for all unregulated AIFs, particularly to the AED. It means implementing stricter CSSF requirements for NAV error handling and depository oversight across the board. It demands robust, institutional-grade compliance and operational frameworks for all fund types, regardless of their formal regulatory status. You need to embrace this. It's the new normal, and frankly, it's a sign of a maturing, more reliable market, which ultimately benefits everyone.
This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.